All right. What is going on, everyone? In this podcast episode, we have a very special guest. He is an award winning financial journalist and is a two-time best-selling author and has experience covering markets and investing in Business Insider. And as of recent, he has left Business Insider to start his own thing and co-founding Opening Bell, which has over 200,000 subscribers currently. So Phil Rosen, what's going on, man?
Hey, thank you for having me. I really appreciate the time.
Of course. All right. So, Phil, let's get right to it. I have a couple questions I kind of want to go through with you. The first thing that I want to cover is the human psychology of investing. And in terms of market cycles, you've seen the meme culture, you've seen crypto, you've seen pandemics happen. What do you think is like one lesson that you've learned from all these different types of cycles in terms of like human behavior?
FOMO is one of the most powerful forces in the world. And that, FOMO, fear of missing out, when people see other people piling into a stock or a cryptocurrency, that is going to convince them way more than looking at spreadsheets, fundamentals, business moats. Those things don't really matter when it comes to what the majority of investors are doing. They're going to look for the hot ticker, the hot meme coin, whatever it might be. And that's what really drives market moves. And, that sounds like a pretty, I think, elementary or basic explanation of what's driving the market. But the market is really a combination of stories that are all coming to meet in the middle of something that determines price. And yes, there are fundamentals, there are balance sheets and cash flows, all that. But I would say a majority of the market doesn't really look at those things. And maybe that's more on the institutional side that's looking at the actual numbers and spreadsheets. But retail, my sense is it's mostly FOMO driven. It's momentum, it's headlines, it's stories, and that's what I would say on that.
Got it. Yeah, I feel like that's pretty spot on. I've seen this happen in the past couple years of just talking about investing. As of recent, right, we had Bitcoin hit an all-time high, and then all of a sudden the DMs were just exploding with questions like, "Hey, should I buy Bitcoin?" But 2 years ago, when Bitcoin was down, no one wanted to ask me anything about it or understand the fundamentals behind it. And I feel like, at least for most retail investors, that's kind of like the overall sense that they're just trying to figure out how they can make money as quickly as possible and trying to like time the market versus just having time in the market is what they call it out there. But I think that's a very important piece. And then kind of just to like follow up on that, right? Sometimes I feel like the FOMO can create these bubbles, right? So you talked about it in that recent interview with the New York Stock Exchange about the bicycle mania in UK. We've seen it with tulips. We've seen it with rhinestones and the dot-com bubble. What do you think is the psychology behind that? Is it, again, just tying to just the fear of missing out, or is there something else I could kind of implement with that?
So there are really a few key components to a bubble, and that's speculation is a big part of a bubble, and you have credit and leverage. So
Mm,
when sort of easy money is name of the game, that's when you have more likelihood of having a bubble. And then you have marketing, and the best people in marketing is the media. They publish headlines about stocks going up, stocks going down, AI, the next big thing, Bitcoin all time high. All these things generate that frothy bubble sense in a
yeah.
market. And that doesn't mean that a bubble is here right now or that there's always a bubble of some sort, but those are sort of the necessary conditions that a bubble will form on top of. So if we look at the market right now, I think the easiest thing to point to, and a question I get all the time, is whether AI is a bubble. And if we're in it right now, we may not be able to see it. A bubble is usually invisible until it pops. You have all the preconditions that I just laid out
Right.
around AI. There's a lot of speculation. There's a lot of gambling on, what the next best thing is. And you can even see in the crypto market, meme coins tied to AI related tools or have AI in the names. Those have kind of already boomed and busted in a certain way. So, there's a lot of levers at play right now, I think. But even I would not be so fast to call this a bubble right now because the other side of all this, yes, you have all those preconditions, but we've never had businesses as big as the ones we have right now. And even though, the Magnificent Seven are down currently on the
Mhm.
year, these are still some of the biggest businesses we've ever seen in the history of business. So in that sense, I'm not as concerned as maybe others might be.
Got it. I would have to agree from that standpoint as well. I was watching a couple other of your videos and just doing the research in terms of just like the profitability of a lot of these companies in the early
Right.
2000s. Just there wasn't any money like pets.com. I forgot the valuation, but it was absolutely absurd. So I feel like there is a difference versus what's going on now versus then. Although I still feel like the FOMO of people messaging me about like, oh, should I buy into Nvidia right now and all these different things when it's like, okay, well, you still buy if it goes down maybe 30, 40%. And that's kind of I guess, where I'm trying to get people to understand a little bit more. Typically, they say be fearful when people are greedy and be greedy when people are fearful. And I feel like people do the inverse most of the time, including myself, including myself. But with that being said, right, you've spoken to hedge funds or large financial institutions. You posted this morning on Opening Bell that newsletter about Warren Buffett just being the absolute goat of investing. And his wisdom seems to be sound through thick and thin. What is it that potentially Warren Buffett understands that maybe us do not when it comes to just markets overall?
It may be less of a question of what he understands and what we don't understand. And he might just be way more disciplined with his capital than everyone else.
Right.
So I wrote this morning, Opening Bell Daily is the name of my newsletter and financial media company. Warren Buffett's Berkshire Hathaway, I think, is up 17% this year. I think they've hit 9 record highs so far in just 3 months almost.
Hmm.
And the S&P is actually negative for the year. And it was only a few months ago the S&P 500 was absolutely ripping. Warren
Wow.
Buffett was selling stocks all of 2024, and he has $334 billion in cash, which a lot of sort of other Wall Street players and media folks have mocked him over holding so much cash
Mhm.
when the market is going so well. And
Right.
suddenly, only Berkshire Hathaway is up out of, I think it was something like out of the 10 biggest companies in the S&P 500, only Berkshire Hathaway has not fallen more than 10% from its 52-week high. And
Right.
Berkshire's actually done the opposite. It's at record highs. So that cash pile is actually looking pretty smart right now. But
Right.
in the short term, let's say the last couple of years, stocks were really going strong. Berkshire Hathaway was allocating cash and selling a lot of its positions in its large equity holdings.
Mhm.
But now Warren Buffett has all the cash in the world to deploy into a discounted market and he's been saying this for a while, that stock valuations were stretched
Mhm.
and he couldn't find anything out that was an attractive price. So
Right.
it's not even that. And I think, you know, studying Buffett for a long time, he would probably be the first to admit it. He doesn't have that much knowledge edge. Let's say he wouldn't say he does. I think really
Mhm.
what he has, he just does not make stupid mistakes and he does not give in to FOMO. So all
Right.
the hype, all the headlines, Warren Buffett doesn't care about any of that. He's looking at balance sheets, fundamentals, what can he hold for decades. So he's not even looking at bubbles necessarily, because bubbles are too short term for a guy
Right.
like Warren Buffett who's been investing for 60 years. So
Right.
he's really a singular figure in that sense. And we could all do a little better to have a longer time horizon.
Right. Yeah, I think that might be spot on in terms of how quickly people are trying to like realize a profit. Because more so Warren Buffett, again, like he was very much pretty much had a lot of his portfolio in cash. And in January, honestly, myself, I was just like, that's kind of weird. I feel like everything is going up. Bitcoin's at 100K, the
Just
stock
rallied.
market's at all-time highs, and I'm just like, I don't know, I guess he's just calling it quits. I mean, he's like 92, 93. That was kind of my understanding of it. I'm just like, he's honestly had a good ride. He's just trying to retire peacefully, I guess. But with that being said, right, in terms of guess like information and not reading all the headlines, I guess more so towards like your wheelhouse of you consistently putting out content every single day. How do you kind of determine what is a signal or what is just noise, like for you?
That's a great question. I read a lot. So I
Mhm.
read what my peers in financial media are saying and writing, and I study the market a lot. So most of my day is actually researching and studying and reading. I always feel I can never read enough.
Mhm.
And that's something I'm always trying to get better at, spending more and more hours of my day just reading. But really, the thing that informs my writing is that I have a lot of people that work in the industry, around different strategy firms and investment firms. And I just get on the phone with them as much as I can. And I call them, tell them, hey, here's what I'm thinking about this particular detail in the market. How wrong am I? And that's sort of how I approach it because, I'm a financial journalist, but that doesn't mean I have the expertise of, let's say, a trader inside of a hedge fund. They're obviously going to know
Right.
their business much more than I will. So I call them
Right.
up and ask them, hey, how are you thinking about this concept in markets? Can you help me understand it better? And it's my job to sort of synthesize all those conversations I have every day and put it into my newsletter each morning for my readers. And that's, I would say a big part of my understanding are those conversations, and that informs the writing, that informs what books I read, what news sources I go to. It all starts with sort of the relationships and the people that I can get in touch with.
Got it. Yeah, information travels through people is something that I've constantly heard.
For
I
sure.
myself, yeah, I myself, I'm pretty naturally introverted, so for me, it was kind of that struggle of kind of just wanting to do everything on my own. But I've realized through just like the paradox of choice, like right now, if I go on X, there's just a million and one different resources. Like there's Pomp, there's you, there's Roll Paul. And if I go on YouTube, like I could just spend infinite amount of time. And I feel like that's something that the audience that I have currently struggle with too, because they're just like they feel like now more so than ever, there's just so many different resources all over the place versus maybe like in the early 2000s you probably had basic cable where you could just like say okay I'll just watch Fox or CNBC and things of that sort. So I was just curious how you kind of filter that data because you're the one that's providing value every single day with that. So I was
Most of
generally
it,
interested. Yeah.
yeah, I would say most of what you see is noise, and it's really hard to determine, okay, how much of this is useful and how much is just going to distract me from either my investment goals or my information goals. And that goes, even beyond Wall Street. You always want to be curating the things you're consuming because to get good outputs, you need good inputs. So I'm always a big believer in picking long form over short form. That's a very basic razor you can use across all social platforms. It'll push you towards more books than more
Right.
articles. And I always think that's really useful. And then investigating the quality of the sources.
Mhm.
One way to test that is how long has it been around? So if you read a book that's been around for a year, you have
Mhm.
no idea if it's going to be around in 50 years. So
Right.
that's why a lot of times I just go to the books that have already been around for 50 years. And I know that information has way better staying power than anything that was published yesterday.
Right.
So those are a couple of filters I use as far as, going for long form over short form and then time horizon. I go as far back as possible sometimes because I want to get to the information that has proven it lasts for generations.
Got it. And what's been the biggest difference? Because Business Insider, for context for the audience, at the time when you were writing it, it had over 2.5 million subscribers on LinkedIn and email. And now you have your own thing, Opening Bell, which has 200 subscribers, 200,000 subscribers. What has been like the big difference from like the creative standpoint?
Yeah, that's a great question. I loved working at Business Insider, to be clear.
Mhm.
I thought my team was great, the company was great, and I learned a ton. Going independent and working with my co-founder Anthony Pompliano has been really fun, really educational. We test a lot all the times. The difference in um, being independent versus being in the big company, there's way less red tape. So we're not running into bureaucracy at every turn, and we can just sort of, well, let's just try this, see how it works, and see how, the design of the newsletter, the style of interview, the type of reporting. Maybe we're doing video content one day that's 5 minutes long, then we're doing 20-minute long. So we can really just test, and that's the beauty of a startup as well. So it's not so much Opening Bell Daily versus Business Insider. It's just startups versus corporate companies. And it's really the freedom to test and iterate as fast as possible.
Amazing. And then I was actually generally curious, selfishly for myself, the premium version. I had seen briefly some of the
Yep.
perks. Could you briefly touch up on that?
So we launched the Best Ideas Club which is Opening Bell Daily's premium offering. That is a stock specific report once a week, every Sunday. And what we do, we're essentially giving our readers premium access to world class investors. I do interviews with people on Wall Street who have been working at these big firms. They know all there is to know. They know way more than I do, certainly. I interview them, get their highest conviction stock pick for the year, and we write a stock report and unpack the thesis, the risks, the financial data, the charts around one specific stock. So every Sunday, we name one specific stock. And, the idea is, okay, to reshape and revamp a portfolio, all you need is one great idea. We'll give you 50 a year. And these are sourced from some of the smartest people on Wall Street. We think it's a no-brainer to sign up for something like this for serious investors that really want to learn, for one, but also get the best ideas straight from the source. So we think it's a really of course we think it's an excellent product. We
Right.
believe in it. I read the reports that I produce because I learn a lot from them and from these interviews, and I think other people will as well.
I mean, you said it earlier, right? Like the information travels to people. You're spending hours of your time looking for these individuals, talking to them, and filtering out all the noise to give people just the definitive, like, not like, I guess, the best decisions, right? Because we never know, but you're getting the people that actually put in hours and hours into their craft to actually understand this from a credible source, which I think is super important because a lot of times on social media, you'll see these 12-year-olds driving Bugattis and saying they day trade or they
Oh, yeah.
do God knows what. And it's like, I feel bad because there's a lot of people that they don't understand the markets. Maybe it's their first time and they're trying to get into investing. And they end up doing these like secret guru day trading things that just like, statistically speaking, it's probably not the best route. And, it's through kind of the foundational wisdom, the boring stuff that seems to be the thing that is what most people should do. But again, I think people fall into kind of the fear of missing out on those huge 10x returns in 5 weeks. And it's like, I don't know how realistic that is long term.
There's really nothing uh that beats dollar cost averaging into the market or a stock or an investment. And that's not going to get you rich overnight, which is why I think it's so unsexy. And it's really hard to sell that. If you say, hey, put $10 a day into this stock or $5 a day into this stock, no one can really capture compounding in their head. And it's really difficult to envision what this will look like in a year, 5 years, 10 years. But if, the alternative that a lot of people turn to instead is trying to get into a hot investment and try to ride it up. But by the time they find out about it, most of the time, it's through the mainstream media, which is only going to write about it if it's already hot. So you're not finding early investment picks. And that's one thing I think Best Ideas Club through Opening Bell Daily, most of the picks that we're on, they're very beaten down stocks. So we're not naming Magnificent Seven or mainstream kind of investments. These are beaten down, undervalued, sort of under the radar stock picks that these world class investors have ultimate conviction will outperform this year.
Got it. And speaking of sexy returns, I know you and Pomp are good friends, and Bitcoin is definitely a big topic here and there on social media right now. What's kind of like your take on Bitcoin? Do you look at it as a store of value or more so like something else?
Bitcoin is inevitable, I think, in many ways. I think now that the White House has embraced it, other nation states will be buying it. And the game theory at play here is that countries cannot afford to not buy it. Once other countries are buying, you don't want to be the odd man out and say, well, we don't believe in it because of XYZ reason, so we're not going to buy it. You just look foolish on the world stage. So I think with the new Trump administration, they've really, really brought it mainstream.
Mm,
So Bitcoin is, in many cases, famous last words, too big to fail at this point.
right.
And, if you look at a sort of a more basic level, it's a computer network that's never been hacked. And that should give, I think, a lot of people comfort in worrying about their tokens. And also it's one of the best performing assets over the last decade at a compounded annual growth rate. It's beat almost every other asset class. So if you look for the last decade of returns, if you look at its safety as an asset, and if you look at nation states embracing this thing, it's very hard to poke holes in the long term thesis for Bitcoin. I really don't buy into any other crypto asset. I think the
Yeah.
rest have a far more likely shot of going to zero than not going to zero. And Bitcoin, I think, it really is the original cryptocurrency. And Michael Saylor has famously said this: there is no second best. And Bitcoin sort of has all the things you would want in a sort of a hard money, digitally native, scarce asset. I'm not one to make price predictions, but I do think Bitcoin is a pretty solid investment right now.
Right. I would have to agree for many reasons in the sense of like the last cycle I had Bitcoin and things of that sort. The only kind of thing left was more so the government kind of just stamping it in terms of like approving it. And it seems like that's already been done. So from my standpoint, I'm just like sitting back thinking, well, like what else is left to kind of like validate or prove? Again, for the audience watching, I always tell them to just be careful and be mindful for how much you invest in anything. It is volatile, but there is a lot under Bitcoin that should be kind of studied and researched in terms of like understanding why people are buying into it. It's not really like I think Charlie Munger called it rat poison squared like in 2017. It's funny because like I was a big Charlie Munger, Warren Buffett guy at that time, so I saw that and me thinking I knew everything. I was like, oh well, there's nothing to see here. They did the research for me, but then once I started kind of tapping into the devaluation of fiat currency and understanding that concept of my cash is just losing value year after year after year, I was like, wait a minute, there's something here that is different from what the central bank is doing with the GTA cheat code of just printing more money year after year.
Of course.
So
Oh,
yeah,
oh yeah. I was
no,
just
go.
gonna say, with Munger and Buffett not buying into Bitcoin, I don't think that's a hit on Bitcoin. That's just the sort of the wise legends sticking to what they know, and I don't
Right.
think that undermines the value of Bitcoin at all.
Right. Right. No, I agree. I mean, I think Warren Buffett is an absolute like genius when it comes to value investing. But again, it's like he is 90 years old. I'm not sure how much he's actually dove into Bitcoin. I think he just stays to his wheelhouse of just figuring out, all right, what is a company that is undervalued? Are they generating cash flow? And then just sticking to the fundamentals because that's worked for him phenomenally. But I feel like, I guess, more so millennials and Gen Zs are we're always trying to go on Reddit forums and go on Instagram and this and that, trying to figure out the next Amazon, the next Apple. So I guess to wrap up the conversation, Phil, what would be one thing you would tell a millennial or Gen Z when it comes to them getting started in investing?
Yeah, I think, of course, the easiest thing, read Opening Bell Daily every morning. I write the letter myself. I send it 5 days a week, and I send the stock pick every Sunday. Anyone at any level should be able to understand the newsletter because I write it very conversationally.
Mhm.
So that's one advantage, and it's free too. The newsletter's free. And I would say read widely and don't give into the hype of a really hot investment because they are so few and far between that I think the majority of self-directed investors would be best served by dollar cost averaging into the broad market. So something like a broad market ETF, S&P 500, things like that. Those are safe, predictable. They have the longest track records, and generally, you can buy them when they're going up. You can buy them when they're going down. You can buy them when it's a bear market, bull market, and those returns will always win over time. So I think as far as not investment advice, but the wisdom of many others, I would say that's a fairly tried and true approach.
That. So, guys, one thing I would say again, there is very few resources that I wholeheartedly recommend. Phil is one of them on the opening bell. I try to read this every morning and I highly recommend you guys check it out. I'm going to put in the plugins for all the opening bell, the premium version, all of that on the podcast episode on YouTube. But, Phil, man, thank you again for your time. It's really appreciated. And hope you have a great day.
Thank you for your time. Really appreciate it.
All right. Cheers, man.
All right.